Okay guys, today we're going to take a look at this video here to try to explain how to work a problem where it asks us to calculate the amount of cash that's been received, the schedule of cash receipts. And so it says, Nuthatch Corporation began its operations on September 1st of the current year. Budgeted sales for the first 3 months of the business are $160,000, $250,000, $500,000. That's for September, October, and November respectively. So the company expects to sell 30% of its merchandise for cash. The other 70% is on account. Of the sales on account, 80% are expected to be collected in the month of the sale and 20% in the month following the sale. So try to kind of color code this. Remember, September is the first month that the business has been in its operation. So let's take a look here. So they sold $160,000 worth of merchandise, and of that, 30% is going to be for cash, and the other 70% is going to be on account. So let's see here. If I added this plus that, I get, voila, $160,000. Okay, so now we have to acknowledge the fact that this amount, since it was sold for cash, we actually received that amount of cash. Now this 70% that has been sold on account is going to be collected, part of it 80% this month and 20% the next month. So this number here is equal to this number times 80%, and this number here, this 22,400, is equal to that number times 20%. So we split it into this piece that we got in cash the month that we sold it, because we actually sold it for cash, and then this other piece here that we sold on account is split into these two other pieces. Now the yellow means that we collected it, that's my color coding to show that we're collecting it in September, and the blue is the part that says we collected the next month, so that's not going to be collected until October. So let's take a look here just to show you. If we add this plus this, it's 112,000, right? And it's just the same. We can see for this is the same as that, and that this is the same as that. That's because all I'm doing is adding these two pieces equal that, and these two pieces equal this, and those two pieces, or I'm sorry, these two pieces here equal this. So it's just that we're splitting up the amount that's being received into two different months, because sometimes people might pay us right away and sometimes it might be a little bit longer than that. So let me clean all this stuff out here now that I've showed you how that works. And so once again, we had total sales of $160,000. We got $48,000 in cash when they bought it, and this was on account. They paid us this month. And then in October, we're going to receive 20% of it. So in October, we're going to receive 20% of the September sales, $75,000 in cash at the time of the purchase, and then $140,000 of these receivables in that month. And then remember, so this is 70% of this total of $250,000. So then we're going to split that 70% into the portion that we received in October, which is the 80%, and then this other part we're going to collect in November. So November, we're going to get the cash from the November cash sales. We're going to collect the $35,000 that was the 20% of the October sales, and we're going to get 80% of the receivable sales for that month. So if we add these two together, let's see here, actually, did I do that right? This should really just be this one plus this one, 430. Oops, I'm sorry. It should be all the green ones for October. Okay, I'm sorry, all the green ones for November. For October, it's going to be all the blue ones. So this one plus this one plus this one. And for September, it's just going to be all of the yellow ones. We didn't have any cash coming from our previous month because this was our first month of operations. And so those are the totals for each month. How much cash would we get? So if it asks us how much cash we're going to get, we can kind of work through that schedule. I mean, this is all kind of, I don't want to say common sense, but you can kind of logically think through this without any accounting knowledge, really. I mean, other than the concept of an accounts receivable, because it kind of tells us in here how it plays out. And this could change. This could be, you know, it doesn't have to be 30 and 70. This could be 90% and 10%. It could be 65 and 35%, just whatever. It happened to be 30% and 70% in this example.